Hey, Steve Saretsky here. Welcome back to the show. Quite a bit to touch on this week. It was kind of like a slower news week, and then all of a sudden we just got hit with some massive policy changes from the federal government regarding immigration. And then we got the OSFI, the banking regulator, saying we're going to cap how much people can borrow. This is all out of the blue. And then we've got an update from the BC government regarding the BC flipping tax and how that's going to impact pre-sales and assignments. So if you're interested in that part, wait towards the end. We'll get to it. But the biggest announcement this week was, in fact, from the immigration minister in Canada, capping immigration. So they're going to slow immigration. Okay, so I want to unpack this because this is incredibly important. I think it's one of the most important policies potentially that we've seen in a long, long time, right? The story in Canada over the last couple of years has been immigration growth, right? You hear it in housing. Hey, you got to buy now. We're importing all these people. Prices are going to go up. Buy. We've been adding 1.2 million people, give or take, per year for the last 2 years. That's a lot of people. There's no way that you can sustainably build enough housing to accommodate 1.2 million people when, the most housing completions you ever done in a single year is 250,000 people, and there's not enough skilled trades in the labor force, and interest rates are surging and nothing makes sense anymore to build. This is a real problem. So you have to get immigration down to sustainable levels. And so you have, of the 1.2 million people that have been coming into the country, the vast majority of them have been non-permanent residents. So this is basically foreign students, temporary workers, okay? So that number has spiked, and that number is definitely cyclical, right? If the economy starts to roll over, there's no jobs, economy stinks, a lot of people will just go home. So we're not really there yet, but we are seeing a situation in the Canadian labor market where you're actually adding fewer jobs than people. So it's starting to get there. So this number is probably going to roll over anyways. But the government's come out and says we're going to start capping non-permanent residents. And so a lot of people just kind of looked at the headlines and says, oh, great, you're just going to cap the number. It's not a big deal. But if you actually unpack it a little bit further, what they're saying is of the 40 million people in this country, over 6% of them right now, about 6.2, 6.3% of them are non-permanent residents. So we actually want to get that number down to 5%. So we want non-permanent residents to be 5% of our population. Now, how are we going to do that? Well, what you're going to do is you're actually going to have to you're going to have to ask the non-permanent residents to leave and get that number out. So non-permanent residents are actually going to contract between now and whenever this policy starts, which is apparently in 2025, into 2027. So we're going to actually see net outflows of non-permanent residents because Canada still has a 500,000 permanent resident target. Permanent resident. Non-permanents, there's no target. And so they're asking the non-permanents to leave. And so what's going to happen is Canada's population growth, which is currently running at 3.2%, the highest in almost 100 years, or 70 years, is going to go from 3.2 down to 0.8% within a year, and then flatline around 0.7. Those are stats from my good friend Ben Rabideau, who's coming on the Loonie Hour next week to unpack all of this. But basically, population growth is going to go from 1.2 million to 300,000 within the next 12 months. And so what are the implications of this? Well, first of all, rapid immigration growth has been pushing rents higher. It's been pushing house prices higher. It's been creating inflation. Okay. It's been creating inflation. Rent inflation alone is 0.5%, 0.5% to headline CPI. So if you get a scenario where even rents just stop going up, right? Because immigration, population growth slows to a standstill, and you get a few more housing completions that are in the pipeline, and you can get a situation where you get no rent growth. That's 0.5% to headline inflation. All of a sudden, they give the Bank of Canada a lot more breathing room to start lowering interest rates. All of a sudden, population growth, which has actually been masking a weak economy. It's actually it's been artificially boosting GDP, right? If you add 1 million people, of course, GDP just goes up. That's why GDP on a per capita basis has been declining for 6 consecutive quarters. So all of a sudden, if you go from 1.2 million people coming into the country down to 300,000, what is that going to do to GDP? That should act as a natural brake on the economy. And that, again, that should give the Bank of Canada more leeway to lower rates. So this is not all negative. If you're looking for relief on the interest rate front, this might be a way to do it. And this might be a way to slow rampant rent growth, slow the froth and the excess in the housing market. This is potentially massive, massive policy that I think everybody should be paying attention to, including, developers and builders, right? Like everyone's like, build. We got 1 million people a year coming into the country, but hold on a minute. This is a drastic turn of events on the immigration strategy. So wait and see, right? Again, keep in mind, the Canadian government has not capped permanent residents, okay? That number is still basically at 500,000 a year. So they still want to approve 500,000 people per year. But in order, if they continue to approve at that rate, 500,000 people per year, then what you're going to have to do is you're going to have to see negative outflows. You're going to have to see outflows, a decline in non-permanent residents in order to get that number to 5% of the total population growth. So this is what the government said they're going to do. Let's see if they actually follow through with it. Let's see how it actually plays out. Keep in mind, we do have an important election coming up next year in 2025 and in the fall of 2025. So is this government even going to be around long enough? So there are some question marks around that, but it is a substantial policy. There's no other way to put it. Switching gears, we had OSFI this week, right? The Canadian banking regulator. Where have they been? All of a sudden coming out and saying they're putting loan-to-income limits at 4.5 times one's income. So each bank is going to be assessed, and they're saying, well, based on your portfolio, we're going to give you this percentage of your book that you're allowed to give loans that are larger than 4.5 times your income. We're now going to put limits on that, okay? And so right now, more loan-to-incomes, okay? The share of new mortgages with a loan-to-income above 4.5 times one income is currently running around 12%. Okay, so not an insignificant number. It was once at 26% during the absolute peak of the frenzy of the pandemic when everyone was boring their brains out. Rates were super low. You could do it. It was a bonanza. So OSFI doesn't want that to happen again. So they're going to say, okay, moving forward, we're going to cap these excessive leverage mortgages. Pre-stress tests, we had people borrowing 7, 8, 9 times your income in some circumstances where you can kind of tweak the numbers on the mortgage side and get this excessive leverage. Now, what do you think happens to house prices when you can borrow more money? You have more money now to bid up the house price, right? I mean, if you can only borrow 3 times your income versus 6 times your income, what do you think is going to happen in that scenario? So I think this is another break on house prices where it should slow the growth. Now, I want to add an asterisk to this because you're going to see all these doomsday comments, people that don't know what they're talking about, that aren't in the industry, don't know how things actually work. I'm going to give you an example from my good friend, Rob McClister. He's been in the business, founded RateSpy, pretty smart guy. I'll give you an example of what the implications are. Because as it currently stands, the way the mortgage stress test is, this 4.5 times loan to income doesn't really have any impact today. If rates come down, when rates come down, it will have some teeth. So it's just OSFI just kind of getting ahead of the curve, perhaps. But Rob gives this example where he says, a family making the average income of $140,000 with no other debt, 20% down, 30-year amortization, and a 7% qualifying rate, right? Because you got to borrow at 2% above your contractual rate. That's the stress test. You'd be able to afford a $581,000 mortgage, and that's 4.15 times your income. So you're below the ratio. That's all you can borrow. Now, if you go back to a scenario where you get back to the minimum stress test, which is 5.25%, so you'd have to have mortgage rates basically back in the threes, this policy would have some teeth. If basically what would happen is if we add back to the original stress test of 5.25, this family would be able to borrow $678,000, so almost $100,000 more. But that would be 4.8 times your income if you were to do that. So under the new restrictions, it would lower it from $678,000 mortgage down to $630,000 mortgage. So there's a pretty big change there, a 7% decline in your borrowing capacity. And so this is another interesting move from OSFI. I think what's going to happen is, listen, if the banks have a certain allocation of their portfolio that they can exceed the 4.5 times loan to income, they're probably going to give that allocation to the really good clients, the clients that have higher net worths, the clients that have a couple credit cards, a line of credit, successful business that they're operating through that bank. They're going to be the ones that get the exception. The people that are going to get squeezed out of the market, and they're going to be a hard cap at 4.5 times your income. It is the single income earner. Okay, it's the single income earner that can't take on the leverage, that doesn't have a lot of income to necessarily work with. They're going to get capped out. And so that's, I think, where it's really going to impact. I wouldn't be surprised if you see some people similar to when we had the mortgage stress test trying to front run the market and get in and say, oh, I don't want to get squeezed out under the new rules and regulations, so maybe I'll do a purchase this year. You might see a little bit of that. So it's going to be interesting. It's going to be really interesting. Again, some of the devil is going to be in the details, similar to the immigration thing we just talked about. The devil is going to be in the details. This is the existing policy. It's just more tightening around the fringes on credit and on borrowing, which I think is wise policy in this country. At the end of the day, we've borrowed our brains out. We've pushed house prices into the stratosphere, and we need to get the amount of borrowing down so we contain the level of house price growth in this country. So that's that. Now on the BC flipping tax, I know we keep flipping gears. Follow along with me. As you guys know, if you flip a house within 2 years, you get hit with a 20% tax from the BC government. That's in addition to whenever you're paying CRA for flipping. Okay. Now the question mark is around pre-sales. How's that? Is it, if I signed a contract with a developer 3.5, 4 years ago and it comes for completion, are you guys going to use the date I signed the contract with the developer? Or are you guys going to use the date that I closed on it at land titles and then flipped it, right? Think about a pre-sale. You bought it 3.5 years ago. You close it. Once you close it, most people want their liquidity. They want out. So 2-3 months later, you sell it on the MLS. So are you going to use the contract date or are you going to use the land title date? We've got some clarity from the BC government saying they're going to use the contract date from the developer. So if you entered into a pre-sale agreement on a high-rise condo in Vancouver in 2021 or 2022, and it completes in 2025, you're going to be exempt if you go to sell it in 2025. Now, if you're assigning the contract, which means you're flipping it before you close, you're not going to be exempt. They're going to look at the pre-sale date and you signed it. So you signed it in, April 2022, and you're flipping it today in March or 2024. That one would be exempt. But now if you go into moving forward, let's say you enter into a contract in today. Well, you bought a pre-sale today. You bought a pre-sale today in March of 2024. And in March of 2025, you go and assign it before it's done completion, you will pay 20% tax. So they're looking at the contract dates of the pre-sale contracts in terms of applying that tax. So I hope that helped. It's a lot of policy changes. As we know, governments are coming out left, right, and center trying to fix housing, new supply things, stress tests this, debt to income ratios that. So it's a lot to keep up with, but that's what this channel is obviously trying to do, keep you guys informed, getting good advice. Obviously, as you guys know, this is my day-to-day. This is what I do for my profession. So if you have questions, put them in the comments or email me directly for the quickest response. do my best to help out as many people as possible. And as always, we'll see you next week.